This morning, the US struck Iran. Within hours, crypto was bleeding red across the board. Bitcoin, Ethereum, the whole market. And if you were watching the headlines, every instinct told you to sell. But here's the thing almost nobody noticed. While retail was panicking, the smart money was doing the exact opposite. Today I'm going to show you 3 sets of data that prove it. And by the end, you'll never read a scary headline the same way again. First, let's get one thing clear, because it's the key to everything today. When people talk about the market, they watch price. Price is emotion. It's fear and greed, second by second. But underneath the price, there's something slower and far more honest. Flows. Where the actual money is moving. And the single best window into institutional money is the spot Bitcoin ETF. Every day, we can see exactly how many dollars the big funds pushed in, or pulled out. Retail reacts to headlines. Institutions move on flows. So when the two disagree, you pay attention. So here's the setup today. The US strikes Iran, in retaliation for attacks on ships in the Strait of Hormuz. Oil spikes. Yields rise. And risk assets get hit first, exactly like they always do in a geopolitical shock. Bitcoin drops to 62,000. Ethereum falls 1.6%. Every screen is red. The crowd sees war, and the crowd sells. This is where the story is supposed to end. It doesn't. Data point 1. For the 10 days leading into this, Bitcoin ETFs were bleeding. A brutal, relentless streak that pulled $2.7 billion out of the funds. 10 days of institutions heading for the exits. If it had continued, that's a genuine warning sign. Real money leaving is the signal that actually matters. But data point 2 is where it gets interesting. That streak just broke. In a single day, flows flipped from negative to positive, $222 million back in. The largest daily inflow in 2 months. Fidelity alone brought in $166 million. Think about the timing. The scariest headlines in months, and that's the exact moment institutions choose to step back in. When retail runs from fear, big money walks in and buys the discount. Fear isn't the danger. Fear is the sale price. And data point 3, the quietest one, the one no headline is covering. Japan's yen is collapsing. And that's pushing Japanese corporations to move treasury reserves into Bitcoin and XRP as a hedge. This isn't a trader chasing a candle. This is slow, structural, balance sheet buying. The kind that doesn't care what happened in the Strait of Hormuz this morning. It just keeps accumulating, right through the panic. Now, let's be fair. The bears have a real argument, and you should hear it. They'll say 1 day of inflows doesn't undo 10 days of outflows. And they're right. Year to date, these funds are still down billions. One green bar is not a bull market. So I'm not telling you to back up the truck. What I'm telling you is simpler. The direction just changed. At the exact moment the crowd was most afraid, the flow turned. That's not proof of a rally. It's a signal about who's buying, and when. So here's this week in one sentence. The headlines screamed sell. The flows quietly said buy. Retail saw a war. Institutions saw a discount. Neither one of them is guaranteed to be right. But over time, I know which side I'd rather be reading. Because headlines tell you what to feel. Flows tell you what the smart money is actually doing. I track these signals every single day, and break them down just like this. If that's useful to you, subscribe, and I'll see you in the next one. None of this is financial advice. Always do your own research.